Every option strategy you will ever see, the wheel, iron condors, the stuff hedge funds run, is built out exactly by two parts, a call and a put. Learn these two shapes properly, and everything else in this series is just combinations. Quick recap from last episode. An option is a contract that gives you the right, but not the obligation, to buy or sell something at a fixed price before a deadline. The fixed price is the strike. The deadline is the expiration, and you pay a premium for that right. Today, we'll see the two flavors that right comes in. A call is the right to buy at the strike. Let's make it concrete. A stock trades at $100. I buy a call with strike 105, expiring in 1 month, and I pay a premium of $2. What did I actually buy? The right to pay $105 for this stock, no matter where it trades until expiry. Now, run the same scenario at expiration. Stock finishes at 100, below my strike. Would I use my right to buy at 105? Of course not. The option expires worthless. I lose the premium, $2. That is the maximum I can ever lose. Now let's think about another example. Stock finishes at 105. Same thing. Buying at 105, what costs 105 in the market gains me nothing. Still minus $2 for the premium. But what if the stock is now at 107? Now the right is worth something. I buy at 105 and it's worth 107. That's $2 of value. Minus the 2 I paid, I break even. Above 107 though, every dollar the stock climbs is a dollar in my pocket. For example, the stock at 120, the option now is worth 15. I paid 2, so I'm up 13. So memorize this shape. Flat loss, small, known capped at the premium, then a kink at the strike, then a limited upside. This is why people compare buying calls to a lottery ticket. You have a known small cost, but an open-ended payoff. Hold this idea, because in 2 episodes, we'll see why this framing is also a trap. Let's now switch to the put. A put is the mirror image. It is the right to sell at the strike. Same stock at 100. Say I buy a put, strike 95, and I pay $2 of premium. I now own the right to sell the stock at 95, even if it's trading at 60. Let's see some concrete examples, as we did in the call part. Say the stock finishes at $100, or anywhere above 95. My right to sell at 95 is useless. I lose the premium, $2, capped, done. Say now that the stock is at 93. I can sell at $95 something that is now worth 93. The options is worth $2, what I paid. So I break even. Now let's say that the stock is actually at $80. My option is worth $15 now, so I'm up $13. The lower it goes, the more I make, all the way down to the stock hitting 0. The intuition that makes puts click for most people is the following. Consider a put as an insurance. You own a house and you buy fire insurance. You pay a premium and you are hoping to never use it. A put on a stock you own is exactly that. You pay a premium for the right to sell at a guaranteed floor. If nothing bad happens, the premium is the cost of sleeping well. One clarification, because this confuses everyone at the start. Buying a put is not the same as short selling the stock. The short seller has unlimited risk if the stock rips upward. The put buyer's risk is the premium, full stop. Same directional view, but 2 completely different risk shapes. Now, every one of these contracts has 2 sides. Someone sold you that call, and someone sold you that put, and their payoff is your payoff but flipped upside down. This gives us 4 basic positions, and I want to show you all 4 at once, because this table is the foundation of the entire series. These basic positions are the following. Long call, you pay a premium, you have a capped loss, and an unlimited upside. This is a bullish bet. The long put You pay a premium, you have capped loss, and big downside payoff. This is a bearish bet or an insurance, if you want to protect your position. Now flip them. You sell a call, you collect the premium upfront. If the stock stays below the strike, you keep it all. That's your maximum gain, the premium. But if the stock rips upward, your losses are theoretically unlimited. You now sell a put. You collect the premium, you keep it if the stock stays above the strike, but if the stock collapses, you are on the hook all the way down. Notice the asymmetry, because it's a philosophical core of options. Buyers pay for capped risk and open-ended outcomes. Sellers, on the other hand, accept open-ended risk in exchange for cash today and a high probability of keeping it. Neither is better. They are different businesses. The buyer is buying lottery tickets or insurance. The seller is running the lottery or being the insurance company. Most of the series income strategies, covered call, and cash secured puts are about being the insurance company safely. Now let's give some space for 3 quick things people always ask. 1. Do I need to hold to expiration? Absolutely not. Options trade like stocks. Most positions are closed early by just selling the contract. 2. When I buy a call, do I ever have to buy the shares? Only if you choose to exercise, and we'll dedicate a full episode on what happens at the expiration date, as it's when beginners get hurt. 3. Why was the premium $2 and not 1 or 10? That is exactly the content for the next episode. We are in the final part of the video, so let's give a quick recap on what we learned today. We said that calls are the right to buy, and puts are the right to sell. The buyers risk only the premium, while the sellers earn it and carry the tail risk. 4 positions and 2 shapes, and everything we build from here is a combination of them. As I said before, the next episode will be about what is actually inside an option price. Because once you see the 2 main components of the premium, half of options behavior stops being mysterious. Thank you for watching. I'll see you in the next episode.